Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, December 30th, 2023. How you doing? Appreciate you coming here to my podcast. Hopefully it's going to be helpful for you. This is my weekend review podcast in which we're going to take a look at all the trades that I made last week. We're going to talk about when I bought them, why I bought them, what the strategy, what the setup was, and then always as most, which is most important, is how I am going to manage the trade going forward. Hopefully, this will give you an idea of what I look for in setups, how I set a good risk to reward ratio, how I position size correctly, and how I manage the trade, either going if it goes my way or if it goes against me. When I have a trade or when I identify a trade, it's not just, hey, I'm going to buy here. I have to have a complete process of how to handle the trade, whether it goes my way or goes against me. And really, what what I'm looking for there is, once I find a confluence combination of indicators lining up, or in other words, I find my entry signal, then the next thing I do is I need to position size based upon the current market volatility. And as we go through these trades, I will show you how I do that. But essentially, I take 1% of my total capital, I divide it by the value of the 2 ATR, then I know my emergency stop. So I always, first thing I do once I enter a position is I have my emergency stop. So I know in the worst case scenario, what that's going to be. And it's the way I do that is it's going to be 1% of my total capital. Now, that only happens 5% of the time. 95% of the time, if I have a loss, it's going to be my end of day stop. So I have two stops. I have an emergency stop and I have an end of day stop. So that's a defensive move. Now, if it moves up, I'm going to take partial profits if it moves up the value of 0.45 ATRs from the previous bar's close. And again, I'll show you this in the charts. That's the offensive part. I like to play both offensive and defensive. Now, once it moves a certain amount of distance from my entry and gets to 1.5 ATR above my entry, then I go into what is called trailing stop mode, which means that if I have a close below a previous bar's low, then I'm going to get out of half. That is defensive. So you have to play offensive. Need to play offense and defense in your trades. All right. So, and I'll show you all that. So we'll take a look at all my trades on the daily, the weekly charts, when I got in, why I got in, how I'm going to manage it going forward, and hopefully that's going to be helpful. After that, we're going to talk a little bit about trader psychology. Always the most important skill in trading is the ability to create a plan and follow the plan. You need a plan first, right? You need a process first, but following it's a whole other thing, right? That's a whole other challenge, and you need to have the discipline to follow your rules, and that always goes back to trader psychology. So we'll talk a little bit about that. And then we are going to take a look at some trades that I'm looking at possibly for next week, both on the daily and the weekly charts. I've gone down through my master watch list. I've identified some trades. Just a minute ago, I talked about the confluences combination of indicators lining up. I have identified, I think, 6 on the daily, 1 on the weekly of what I am looking for and what those confluences and what those levels are that have been rejected that will ultimately give me a good risk to reward ratio at a valid support level. So they're not there yet. If they were there right now, I probably would have already taken the trade. But it's important for me. Friday nights, I always go through all my charts, and I look at these charts and I say, okay, not there. Ooh, but if it does come down to this level, this is happening at that level, that's happening at that level, and if it does get there, I'll potentially take the trade. And it's a good way to be in a quiet space in your mind and just objectively look at a chart and go, okay, if it gets there, that makes a lot of sense because A, B, or C. And if it doesn't get there, okay, fine. I'm just not going to take the trade. And eventually, something that I'm looking at will get to that level that I'm waiting for. And doesn't mean the trade's going to work out, but it means it's getting to the spot that makes sense to me based upon support, price action, so forth. All right, so hopefully this is going to be good. Hopefully it'll be helpful for you. I hope you had a good week. I hope you had a good trading year. Looks like Monday is going to be first day of the new year. So I wish you all of you a good new year, health, wealth, happiness in your life, and wish the same for me and wish the same for everyone. So before we get started, I need to run the U.S. legal disclaimer. Hang tight. I'll be back in about 40 seconds. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, thanks for holding through that with me, and let's get started. This is Caterpillar. Now, I've been in Caterpillar a long time. And just as a general rule, if I'm in a trade for a long time, it means it's a profitable trade. Generally, if you look at trades that I have losing trades, and I have a lot of those too, but I'm out quickly. And that's a key tenet in trading. Be patient with your winners. Be very impatient with your losers. A lot of people do the exact opposite. They hold on to losers because they think things are going to come back. They get out of winners quickly because it feels good to take profits. But Caterpillar is a perfect example. And let's go all the way back to when I got into Caterpillar and why. And I've mentioned several times already that I look for confluences and combination of indicators lining up before I take the trade. Doesn't mean you're going to have a profitable trade, but it increases the chances of that happening. So I entered into Caterpillar back here on the 1st of November. Why? Well, look at the orange line here. The orange line is the 300-day moving average. This is one of the strategies that I teach called the deep dip buy stock trading strategy, and it has to do with the 200-day moving average, the 250-day moving average, and the 300-day moving average. This is a legitimate, strong level to key your trade off of. You can see the day before I entered, we closed below. The day of the entry, we closed above. That by itself is a legitimate entry. But it also, the day before, closed under the 30 RSI, and then on the day I entered, closed above the 30 RSI. So I have two legitimate signals happening at the same time. So that's my entry signal. I got in at 231.60. Now, I talked about why to get position sizing. So let's just pretend that we just got into this trade. Let's just say I have a $100,000 account. 1% of $100,000 is $1,000. If you have a $500,000 trading account, 1% is $5,000, right? If you have a $50,000 trading account, it's $500. So hypothetically, $100,000 account times 1%, $1,000. I look at the value of the 2 ATR, which is currently 1157, divided by 1157, tells me to buy 86 shares. And that is, we've come up with that because of the volatility of the last 20 days. It tells me that based upon my account value and risking 1%, that is how many shares to buy. So there's my entry. Now, immediately, you see the red line down here? This is my emergency stop. This is exactly $11.57 below my entry. So if I have 86 shares and it travels down $11.57, how much have I lost? I've lost $1,000. That's the maximum. Now, again, that only happens 5% of the time. 95% of the time, my end of day stop is going to come into play. Where's my end of day stop? Well, why did I take the trade in the first place? Because we closed under the 300, closed over the 300. If the next day it had simply closed below the 300, I would have been out for a small loss. I mean, even if it got to my emergency stop, I'm only losing 1%. But even hypothetically, the next day, if it just closed below the 300, I am simply out of the trade. Now, I have an orange line here. This is 1.5 ATRs above my entry. Remember, emergency stop's 2 ATRs below, but my trailing stop level is 1.5 ATRs above. So that means if and when I get to my trailing stop level, then in the future, if I have a close below a previous bar's low, I will get out of half like I did here. Now, I talked about taking partial profits. It's very important, a huge part of my trading. And let's just go to the current level where we are right now. I take the closing price of the day, 295.67. I add the value of the 0.45 ATR, which right now is 260. So this will be for Tuesday. Take the closing price plus whatever the 0.45 is. Right today it's 260 plus 260. On Tuesday, my first profit target will be 298.27. Then I take 298.27. I add the value again plus 2.6. Second profit target for Tuesday is 387. I'll add it one more time. 303.47. So those are my 3 profit targets for Monday. Maybe I'll hit 1, maybe I'll hit 2, maybe I'll hit 3, maybe I'm not going to hit any. And you might ask, well, how much do you get out of at those profit targets? It's very simple. For me, it's 10% of the shares that I have remaining. All right, so let's start again. Why took the trade? We had to close under the 300, close over the 300, close under the 30 RSI, close over the 30 RSI. Position size correctly, place my emergency stop 2 ATRs below, place my 1.5 trailing stop 1.5 above, and then of course I take partial profits every time it moves up. Well, the very next day it moved up, I took a partial profit, took 10% of the shares off. Next day moved up again, got to my trailing stop level, which means now that if I have a close below a previous bar's close, I will get out of half. Unfortunately, that happened here on the 7th. First close under the previous bar's low. After reaching trailing stop level, I locked in half of the position for a gain of 1.31%. Then we just continued. We moved sideways, We had an up bar, took some profits, had a big up bar, took some profits, had a big up bar, took some profits. Then we had a little move down. Then we had sideways, and then we really took off to the races. Took some profits here, took some profits here. I think I hit 3 profit targets here. Took a profit target here, took a profit target here. So this has been a monster trade with the remaining shares that I have. As a matter of fact, at the moment, the remaining shares that I have on this trade are up 21.66%. So this is a very good illustration, everyone, of risk to reward. I was patient. I waited for my confluence of setups, under 30, over 30, under 300, over 300. Literally, if we would have just closed below here, I simply would have been out of the trade. But look at the move up. The reward was huge compared to the potential loss. And that's what trading is about. Being patient, waiting for your signals, giving yourself a good risk to reward ratio. Of course, this doesn't always happen. This has been a crazy market. But in essence, that's what trading is about. Now, how to get out of this? Well, I have a lot of different rules. And by the way, if you are interested in learning how I trade, I do offer a private one-on-one course in the evening time via Skype. The course is 5 sessions. Each session is 3 hours, so it's an intensive course, but I've been trading for 28 years. I have a lot of rules. Every rule I have, there's a very specific reason that I use it, and I will teach you these all. I have students from all over. I've taught students from all over the world, from absolute beginners all the way up to the hedge fund level and everywhere in between. And so if you're interested in learning a new skill for the new year, please email me. My email is in the link of this description, and we can start, communicating. But I love to teach, and I teach good things, and I promise you, when you're done with this course, you will be a much better trader. I just can't imagine that you wouldn't be. All right. So, and in that course, I teach you all of these different rules. So, and why I started talking about this is I have a rule that once you get to a 65 RSI, right now we're at 77.36. So once I get to 65 RSI level and we close below the 5 EMA, that's the blue line here, then I am going to just be simply out of the trade. You can see on Friday during the day, we were under the 5 EMA, but we closed above. That's the key. Had we closed under, I simply would have just been completely out and done with the Caterpillar trade. But really good, great example of being patient, wait for a confluence of signals to happen, taking partial profits on the way up, and most importantly, having a process to know what to do regardless of what the market is doing. So just going forward here on Caterpillar next week, Tuesday, Wednesday, whenever, if we close under the 5 EMA, I will be completely out of the trade. But again, this trade up 21.66%. So that's Caterpillar. All right, let's go through Walmart. Another really good trade on Walmart, bought down here on the 12th of December. Why? Well, what were the signals? The signals were, you see the purple line here, this is the 250-day moving average. This is a key level that large financial institutions key off of. The previous day we closed under the 250, and the day that I bought it, we closed over the 250 on Walmart. I entered at 151.35. I position sized. I placed my 2 ATR emergency stop below. Where's my end of day stop? Simply a close below the 250. Next day, moved up strongly, took some profits. A couple days we came down, but we held on a closing basis the 250. Next day we moved up again. I took some more profits and we got to trailing stop level. And then here on the 20th was the first close under the previous bar's low. After reaching trailing stop level, I locked in half of the remaining position for a gain of 1.53%. And then the rest of this week just moved up, moved up here, took some more profit targets inside day, moved up again on, I guess that was Wednesday, took some more profit targets, and then we've kind of moved sideways from here as well. 55, 52 RSI. If we get to 65 RSI, then this 5 EMA will come into play. So this trade, the remaining shares of Walmart on this trade doing very well, up 4%. Oil. All right. So oil, a little different type of strategy. This is called a island reversal, and also an abandoned baby if you like. I have a nice YouTube video on my YouTube channel talking about island reversals, abandoned babies, and why I like them so much. But this is what I'm using. This particular trade, I don't scale out. I don't have trailing stop levels. This is kind of a this is going to happen or that's going to happen. Well, let's start on why I bought USO oil in the first place. You can see the highlighted blue bars here. This is what's called an island reversal. And again, go to my YouTube channel. You'll see the lesson on it. What is an island reversal? An island reversal is when you gap down. So there was really negative sentiment for whatever reason. Then you had a bar sideways, and then here we gapped up. You see how it leaves this like a little island here? So sentiment was very negative, and then switched immediately to positive. Now, this would have been a legitimate entry to buy this at here. I didn't buy it. I wanted to see if it would come back down and kind of try to close that gap. It did, and I got long here 66.02. Now, on these particular trades, and again, this is what I teach in my one-on-one course, but on these particular trades, I have a 2 ATR stop below, and I have a 4 ATR profit target above. So I really don't have to manage this trade. All I know is if it gets 2 ATRs below my entry, I am simply out for a loss. If it gets to 4 ATRs above, I'm out for the game. And that makes sense from using good trading principles in that it's a good risk to reward. If I'm wrong, I lose 2x. If I'm right, I make 4x based upon a valid signal. And you can see right away it took off nicely, nicely, nicely. I didn't take any partial profits. And then the last few days it has come down. It's still up at the moment. How much? About 1.02%. But I like to have different strategies, different approaches. And so on island reversals and on abandoned babies, it's one or the other. I'm either going to make 4x or I'm going to make 2x, but based upon a legitimate entry signal, as we have here. And I think, did I highlight these? Yeah, if we go back in time, I'll just want to show you some other island reversals. This was an island reversal, definitely some ability to make money here. Here was an abandoned baby. Abandoned baby is just one bar. That certainly nailed that trade. Over here, we have an island reversal here. Definitely ability to make money on that trade. And then again, here's the trade that I took here. Why? Because of the abandoned baby. So still in this trade, it's going to be a 2 ATR loss or a 4 ATR gain. Currently, it's up 1.02%. Alibaba. Okay, so little different strategy here as well. If you're familiar with ICT strategy, you can look them up on YouTube. Very, very good strategies. But I did buy Alibaba here at 72.35. Why? Well, kind of hard to get into this one without a complete lesson. But what I look for is I look for a bottom, a level of liquidity. I look for the level to be run. And then I look for a change in market structure. And what constitutes a change in market structure? I look for the first pivot point that we take out. So here was a level of liquidity. We ran the level of liquidity. On this day, on the 14th, we went above that high, which changed us into a bullish market structure. We kept going up, kept going up. It left a fair value gap from the bottom of the 15th to the top of the, sorry, this one's down a little bit, to the top of the 13th. So anywhere in this blue box here is a legitimate entry point. And the very next day it came down, touched it. I decided to go ahead and take the trade. I got in at 72.30. Placed my 2 ATR stop here below. Place my 1.5 ATR trailing stop above, and of course, as it moves up, I take partial profits on this approach. We had a nice move up, took some profits. Next day, down. Next day, huge bar up, took 2 profit targets. Now I'm in trailing stop mode, which means if I have a close below a previous bar's low, then I'll get out. Next day, held the previous bar's low, moved up again, took some more profits. Here during the day we were below, but we closed above, kept me in the trade. On Thursday, jumped up again, took more profit targets. So this trade doing very, very well. I'm in trailing stop mode, but haven't taken anything other than the partial profits, up 6.83% in just over a week. So you can see I use a lot of different approaches, and this has been a great trading week. SPY. Okay. This one, interesting. Again, this is another approach that I teach in my private one-on-one classes. I studied one-on-one with Dr. Alexander Elder, and what his favorite trading approach is what's called double bottoms, bullish divergences, or double tops, bearish divergences. Well, this is the SPY, and what we have, I mean, yes, it's going up very strongly, but if you look at them from a MACD divergent standpoint, you will see that we seem to be running out of buyers. Look at this high here. See how high the green bars are? Very, very, very strong. Then we pulled back into some red. Now here we are higher than we are higher here, but you see how the green bars are a lot less high, or they're shorter than these. This means we are potentially running out of buyers. Now, I also have the blue line here, blue line here. These are fair value gaps. I showed you the bullish fair value gap on Alibaba. Well, this is the opposite. This is a bearish fair value gap way back from 22. And so there's a lot of things involved in this trade. One, we got into this fair value gap. But here I got short because we rejected the top of that fair value gap and we created a V1. So more stuff to throw at you. So an approach that I use in a lot of my trading, really important approach called V1s, V2 entry signals. Now, you can look on my YouTube channel, just type in V1, V2. In my channel, you'll see a video that I've done for you. I use them both to the long side and to the short side. This is a bearish V1. Here is bar 1, bar 2. You see how bar 2 went above bar 1 and then closed below bar 1's close. That's a very bearish signal, especially in context of this double top bearish diversion. So I did get short here. I took this trade intraday. I did get short here at 474.10. And that was that big down day we had a couple Wednesdays ago. And so on the way down, I'm using the same 0.45 ATR profit target. So I hit 2 profit targets on this day because I got short at 474.10. It moved down so strongly that it hit 2 profit targets, took 20% of my trade off in profitable levels. And we also got to my trailing stop level, which was 1.5 ATR below the entry. So now I go into trailing stop mode, which means if I have a close above a previous bar's close, I'm going to get out of half. Next day went up, but didn't take out a previous high. Next day went up again and did close above the previous bar's close after reaching trailing stop level. So I took off half of the remaining short I had for a gain of not much, only 0.11%. But remember, I had all the move down here where I took profits off. Okay, so my stop on this is the high of the order block way back in 22. So if I close above 479.98, I am simply out of the trade. What's this red line up here? This is my 2 ATR stop, right? This is my end of day stop. This is my emergency stop. So next week, if we close above here, I will simply be out of the trade. If we get up to here for some reason, simply be out of the trade because that's my emergency stop. But the key point I'm trying to make here is, look, I took off half of the position here because of my rules. That's why it's so important that you have rules. You know, every day you can have different personality, you can have different moods, but in trading, you have to, it will just make your trading life so much easier, everyone, if you just have good rules based upon good technical trading, a good technical trading process that regardless of what it does, you know exactly what to do. It takes so much pressure off. So Friday, by the way, we did move down more than 0.45 ATRs from close, so I was able to take a little bit more off before it rallied. So this particular trade right now, slightly down on the remaining shares, only down 0.28%. Okay? All right. UUP is a trade that I took on Thursday. Why did I take this trade? Well, I took this trade on Tuesday because of this black line here. This is the 200-day moving average. The previous day we closed below. On Thursday we closed back above. That's simply the trade. So I position size correctly. I placed my emergency stop 2 ATRs below. Where's my end of day stop? Why did I take the trade in the first place? Because we closed under the 200, over the 200. Therefore, in the future, if we simply close below the 200, I'm simply out of the trade. Orange line up here. What's this? 1.5 ATR trailing stop level. If it gets there, then I'm just simply going to go into trailing stop mode, which means then in the future, if I have a close below a previous bar's low, I'm simply going to get out of half. But I was very patient with this trade, waited for it to reject this key level, which is the 200-day moving average, and that's it. Now, on Friday, we gapped above these 2 bars. We gapped down, we gapped above. This now makes this a island reversal, a bullish island reversal, which makes me concerned about the market in general. And a little later in the podcast, I am going to go through the market, the major indexes, bonds, dollar, so forth, to kind of make the case of why I think we could be very, very close to a top. All right. But So we did create an island reversal here, which is positive for this UUP for the dollar trade, but I'm concerned it is going to be negative for the market. But just taking this trade at face value, it closed under 200, over 200, position size correctly, placed my emergency stop, my end of day stops closed below the 200, 1.5 ATRs above as my trailing stop level. This trade has started out decently, up 0.26%. And then India. India was a trade I took on Friday, yesterday. Why did I take this? Well, I took this because of this abandoned baby, a bearish abandoned baby. You see the blue here. See how we gapped up? A lot of positive sentiment. On Friday, we gapped down. You see how it leaves this bar all by itself? Here's an abandoned baby as well. I didn't take this short because it moved so far down that the risk to reward ratio was horrible, but I did take this short here at 48.89. And again, this is one or another. It's either going to go up and hit my 2x stop, or if it goes down, it's going to hit 4x profit target, which is correct. I'm risking less than I'm potentially making based upon a completely legitimate entry signal, which is the abandoned baby. So let's see real quick. It's up 0.08% so far on the trade, but just for keeping score. All right, so that's it. Abandoned baby. And if we look back in the past, everyone, on these abandoned babies or these island reversals, you will see pretty accurate. Look, abandoned baby here. Just like I took here, abandoned baby to the downside. Was it correct? Boy, I would say. Abandoned baby to the upside here. Bullish. Was it correct? I would say. So you can see why I like abandoned babies and island reversals so much. And this was a bearish abandoned baby. And that's why I took the trade. And again, 2 ATR stop to the upside, 4 ATR to the downside. So real quick review on the daily chart. Caterpillar up, the remaining shares up 21.66%. Walmart remaining shares up 4%. USO remaining shares up 1.02%. Alibaba remaining shares up 6.83%. SPY loser down 0.28%. I can deal with that. UUP up 0.26% and INDA up 0.08%. All right, so those are the daily trades. Let us move over to the weekly trades. I like to trade on multiple time frames. And again, everyone, some of these trades I've been in a long time. And if I'm in them a long time, what does that mean? That means simply that they are profitable. If they weren't profitable, I would not be in them. You'll see with my trades that if they're losers, I am out quick. If they're winners, I just stay with them until my rules tell me not to. So I've been in this trade for 9 months. So definitely a profitable trade. XLF, which is the financial select ETF. Entry signal. Well, look at the purple line down here, the weekly 250 week moving average. That was my level. That was my level that during the week, weekly bars close on Friday. So during the week, it went below, closed back above. That is my entry. My position size. I placed my emergency stop 2 ATRs below. I don't have it there anymore. My end of week stop is simply a close below the 250 week. And off to the races. Placed my 1.5 ATR level above. Next week, moved up, took some profits. Next week, moved sideways. Next week, moved up nicely, took some profits. Now I'm in trailing stop mode because we got to trailing stop level. Looking for that first close below previous bar's low. We went sideways for about a month, never closed below. Then we moved up, and then here on the 23rd of June was our first close below a previous bar's low. I got out of half for a gain of 6.4%. Then we had another straight up month where I took profits. Then we kind of moved sideways, didn't do much. Then we had this huge move down in October. Here, see this see the purple line. You see how during we went below and closed back above? I should have got into a whole new trade there, but I didn't. But I kept the remaining shares that I had. And then the next week, massive, hit a bunch of profits to the upside, sideways motion the next day. Next week, moved up again, more profits, moved up again, more profits. 3 weeks ago, huge bar up, took lots of profits. We are at a 67.99 RSI. If we reject the 70 RSI, which we have not yet, if we reject it, then I'm going to sell half of the remaining shares. Then if I have a close below a previous bar's low after rejecting the 70, I'll be out of the trade. Or third option, I'm certainly above 65 RSI, and if I'm above 65 RSI having a close below this 5 EMA, I'm simply just out of the trade. So this has been a monster trade. Remaining shares up 18.27%. But again, I just want to take your attention back to where I entered. My risk was quite small, right? In context, it was quite small compared to what I get, and that's what's important in trading. So XLF up 18.27% on the remaining shares. And then last trade, J&J on the weekly. I took this trade 2 weeks ago. Confluence of signals. The main signal was the rejection of the 200-day moving average. This is the black line here. And so during the week, we went below, closed above. That told me that there were, at the moment, no one was willing to sell under this level. And then we also have a V1. Remember I was talking about V1s, V2s? V1 consists of two bars. Bar 1, bar 2 goes below the low of bar 1's low. Bar 2 closes above bar 1's close. That was my confluence of signals. Intra-week rejection of the 200 and a V1. What's the red line down here? It's my emergency stop. If I got there, I'd only lose 1%. If it just simply closed below the 200, even by a penny, I would be out for a very small loss. So far, this hasn't been a huge mover, but not bad. It's up 1.6% in 2 weeks. Orange line up here is my 1.5. So recap on the weeklies, XLF up 18.27%, J&J up 1.6%. So those are the trades, everyone. Hope that was helpful to take a look at, kind of how I look at these setups and these structures and try to give myself a good risk to reward ratio based upon a very significant level, like a 300-day moving average, a 30 RSI, a 250-day moving average, a 200-day moving average, and how I follow the process here. So before we take a look at the symbols that potential setups that I'm looking at for next week, let's do a little bit on trader psychology. This is from my very good friend Steve Burns from the New Traders, Rich Traders channel over on Facebook. Steve is a great guy. He's a great trader. He was my mentor for a couple years. Great author. Look up his books on Amazon. He has written many of them, and they are very, very good. You can also follow him on Twitter at @SJosephBurns on Twitter or X. Let's see what Steve has to say. Position size and emotions are highly correlated. Reduce the first to manage the latter. Okay, makes sense. If you buy one share of something, do you think it's going to be easier to stick with the plan that you had at the outset of the trade? Yeah, of course, because it's one share. You just don't really care. But if you buy 10,000 shares, does it make it more difficult to follow your process? Absolutely, because maybe the next day it goes up. You're like, oh my gosh, I could have bought a jet ski or something, right? But that's not the way to look at it. You need to look at it in following the process. So position size is key. The larger the position size, the harder it is to follow your process. And what I have noticed and discovered in my 28 years of trading is you almost certainly always make more with a smaller position size than a larger position size because of what Steve is saying. Position size and emotions are highly correlated. Reduce the first, so reduce your position size so that you can manage the trade better. So remember that. In the long run, in my experience, you're going to make more with the smaller position size than with a larger position size, because you're going to be able to follow your process easier with a smaller position size, which really means you should just follow your process. If you can follow your process with a large position size, good on you, but it's harder. You kind of have to acclimate to that larger position size. But this all comes back to get yourself a process. Get yourself a process so you don't have to make on-the-fly decisions. And you're going to make a lot more on-the-fly decisions with a large position size than a smaller position size. Make sense? Thank you, Steve. Appreciate that. And keep that in mind, everyone. In my experience, you're going to make more money with a smaller position size following a process than a larger position size where you don't follow the process. So follow your process. And if you need a process, contact me. I teach these processes. You'll never not know what to do. All right? All right, let's head over to potential trades for next week. Now, again, these trades are not where they need to be. Okay? If they were there, then I would already be in them. And when I go through this, if this seems complicated, I try to make it very basic here. But if you need help, email me, let me know. Interested, I'll teach you. If you take my course, I'll teach you absolutely step by step. I'm a very patient teacher, and we do 15 hours of this stuff. We do all sorts of simulations and so forth. So when you are done with that course, you are going to know exactly what to do. So if you want to start that process, just send me an email. My email is in the link of the description. All right. And I know you're going to be happy you did. All right, here's Apple. This is something that I teach at my course. This is called a return to value V1 or V2. You see the green lines here? The top green line, the bottom green line. Anywhere in here is called the value zone. I very rarely buy anything above the value zone. I don't want to buy above value. I want to buy in value and sell above value, or buy below value and possibly sell in value. So really anywhere above this green line for most of my trades is kind of a no-go zone if I'm long. But you see here, we were above the value zone, clearly. Now we've come back into the value zone. Okay, so now at least it's in a value zone. This is Apple, by the way. And now we need some sideways motion to show that there is some balance of buyers and sellers. Here, it was all selling. Now, you see how we're moving sideways? This is balance. Now I'm just looking for a trigger to enter the trade. Well, we don't have a V2 yet, but now this is for for Tuesday only. Here is bar 1. Bar 2 goes below the low of bar 1's low. It's washing out. This is what I call the washout bar. Monday only. If we close above bar 1's close, that's why I drew the line here, 193.58, we will have a return to value, right? We return to the value zone, return to value, sideways motion, and then I need the trigger for the trade, which is simply a close above bar 1's close. Bar 1, bar 2 goes below bar 1's low, bar 3 just needs to close above bar 1's close, which is 193.58. Stop is going to be a close below halfway of this washout bar, if that happens. But again, it could just go down and then the trade's invalidated. But Monday only, if we close above 193.58, it will be a textbook perfect return to value, sideways motion, V2. So Monday only, if we close above 193.58, that will be my potential entry point for return to value V1, V2. Adobe. Oops. Now, I'm also looking for a V1 or a V2, but this is completely different. You see, we had earnings, and apparently earnings were bad because it dropped strongly. Just kind of as an aside, I never hold through earnings because of this reason. That's just one of my general rules in trading. I never hold through earnings. If I'm in a trade and earnings come up, I simply get out. On Apple, I showed you that we closed above the value zone and came into the value zone, sideways motion looking for the V2 on Monday. Adobe, opposite. You see how we closed below the value zone? Here's the bottom of the value zone. This is called a higher low V1 or V2. First rule is that you need to close below the value zone. Then you need to enter into the value zone, which it did. Then you need to pull back, which it has. Now I am simply looking for any time next week, a V1 or a V2 to get me long. And let's just say Tuesday, we go below Friday's low and then go back up above it. That low would be higher than this low. So I also have a video in my YouTube channel called V1s, V2s, so go and check that out. It's a good video, and it kind of shows you the differences here. So two different type of potential V1s, V2s. Return to value V1, V2, Tuesday only on Apple, 193.58 is what I'm looking for. And Adobe, we closed below the value zone, came into the value zone, pull back, looking for a higher low V1 or V2 anytime next week. Okay. Berkshire Hathaway, same thing. Don't get a lot of these, but we have a lot of them this week. Look, we closed above the value zone back here on the 13th. We came into the value zone. We're back in the value zone clearly. We have sideways motion clearly. And so Tuesday only, I am looking for a V2. Look, we're setting up bar 1. Bar 2 goes below the low of bar 1's low. Bar 3, Tuesday, just needs to close above 357.57. That would be a completely legitimate return to value V2. Walt Disney, DIS. Okay, well, Disney had a big move up, and now we have just moved down, moved down, moved down. What am I looking for? I'm looking at this 200-day moving average. I'm looking at this black bar. You can see back here on the 5th, intraday, we went below, closed above. That would have been a legitimate trade and would have worked out nicely so far. But what I'm looking for next week is potential rejection of the 200-day moving average, meaning it either goes down, bounces, that would be legitimate, or during the day it goes below and closes above, that would be legitimate, or it simply closes below the 200 and then in the future it closes back above the 200, and that would be my entry point, my end of day stop, the 200-day moving average. And we kind of have just drip down, drip down, drip down, which is good. I like drip downs to the 200 a lot better than just down, down, down skyscrapers. So don't know if Disney's going to get down here or not, but if it does, I would consider taking the trade. All I can look for is a good risk to reward ratio at a key level, which is the 200-day moving average. VIX. All right. Well, VIX has just gotten absolutely hammered this year. But I like VIX because there are a lot of signals here. Massive, massive signals. I'll just kind of take you big picture. Drawing this trend line out here from this low connected to this low, this is a long-term channel. We're getting very close to the bottom of that channel. You see, will it bounce there? I don't know. But there are a lot of things going on in this VIX chart that make me very bullish on VIX. Look at the lows here. Look how deep these red bars are. Extremely deep. Are we lower here than we were here? We certainly are. But look, there are no red bars here whatsoever. This is called a double bottom bullish divergence. So this is actually why I am quite bearish on the markets in general, because the VIX and the markets are going to be inverse of each other. This is extremely bullish. Look here on the 14th. We're at the negative 4th ATR channel. Now we are lower. We're only at like 2.5. Look at the RSI. Look at the low here. RSI blue line very deep down here. Now we're lower, way up here. Triple bullish divergences on VIX. Nobody wants it. Everybody hates it. That's why I like it. Not for real reasons. Like I just said, double bottom MACD divergence, double bottom ATR divergence, double bottom RSI divergence. getting close to the long-term channel. So everything's perfect, but where do I enter VIX? Well, or if I'm going to enter VIX, we're to 32.94 RSI. If next week we go under the 30 and then close above the 30, that will be my entry signal. Just to close under the 30, whether it's intraday or day to day, and under 30 over 30 would be give me a very, very good risk to reward ratio in the context of massive bullish divergences, MACD divergences, RSI divergences, ATR divergences, long-term trend line. So can you kind of see why I'm a little bearish on the market in general? Because if VIX bounces here and bounces strong, then the market will be going the other way. So to sum it up on VIX, with all these divergences, long-term trend lines, I am looking for an under 30, over 30 to enter me into the trade. If it does do that, then the 30 RSI will be my end of day stop. Exxon. All right, well, you can see Exxon had a island reversal back here. Interesting, right? Had the island reversal, gap down, gapped up, left these two bars all by themselves. Two potentials here on Exxon. I drew this green line. What is that green line? That's the top of the island reversal. So next week, if we come down, test this and bounce off of it, then I will go into those one or the other trades where I'm going to place my emergency, or I'll place my stop 2 ATRs below, my profit target 4 ATRs above. That is potential. Another potential is that we just move sideways and then we have a V1 or a V2 to the upside, like I mentioned on some of the other trades today, would be a higher low. Because look, we close below the value zone, we rally into the value zone, we pull back. So a V1 or a V2 to the upside would be a legitimate higher low V1, V2. But in addition, we have the strength of this island reversal here as well. So I really do like Exxon. And depending on what it does next week, I may just be able to get into the trade. Now, look, Tuesday, we may have a higher low V2. On Thursday, we have bar 1. Friday, we went below bar 1's low. If we go up on Tuesday above, I guess I should draw the line there, close 119. There's your V2 signal, but that's Tuesday only. Close below the value zone, into the value zone, pull back. We're already formatting for a higher low V2. So let's just imagine Tuesday we go above 119. We have bar 1, bar 2 goes below bar 1, bar 3 closes above bar 1's close. That low would be higher than this low, higher low, V2 in the value zone. And cherry on top of this trade is that we have the strong support here of this island reversal that formed. So now, potentially next week, we could have all 6 of these trigger on the same day. Does that mean I would take all the trades? No, absolutely not. I only take 1 trade per day. So all 6 of these could trigger on Tuesday, but I'm only going to pick the best trade. What makes the best trade? How am I going to decide that? Which one has the most confluences, combinations of indicators lining up? Which one has the best risk to reward ratio? Which one is strongest relative to the market of that day? Which one looks the best on the higher time frame? If I'm trading dailies, then looking for potentially, or if I'm trading dailies, I want to look to the weekly bars to see if there's also some confluences and rejections of levels on the higher time frame. So it's a real skill to be able to take 5 legitimate signals or 6 and narrow it down to the best one. And again, this is what I teach in my one-on-one course. Which one's the best? Which one has the multiple time frame? Which one look best? Which one has the best confluences of and combination of indicators lining up, even on multiple time frames? Risk to reward. Again, this is what I teach in my class, and so that's why I really suggest that if you want to learn from someone who's traded for 28 years, please contact me. We'll set it up and you will learn a skill that you can use the rest of your life. So, just as a recap on potential trades next week, Apple Tuesday only. If we close above 193.58, I will consider taking that return to value higher, return to value V2 trade. I'll consider that. Adobe, if we get a V1 or a V2 next week, I'll consider taking that higher low V1, V2. Berkshire, Tuesday only. If we close above 357.57, that would be a return to value. V2 in the value zone, I consider that. Walt Disney, if we get some kind of rejection next week of the 200-day moving average, consider taking that. VIX, if we go under 30, over 30 with all the divergences going here, long-term trend line, I will certainly consider getting long VIX. And then last but not least, ExxonMobil, two potential on this. If we go down, close the gap of the island reversal, I'll go with a 2 ATR profit target, 4 ATR profit target, 2 ATR stop. Or if we just move up on Tuesday, then we will have a higher low V2, and I'll potentially take that trade as well. All right, so hopefully that's helpful. Let's go over to the weeklies. And I only have one on the weekly, everyone, and it is VIX again. I really like when I have potential trade on both the weekly and the daily. Well, here is VIX on the weekly charts. And again, red bars here in the 24 range. Now we're at the 1550 range. Are we lower here than here? We are. Are there any red bars here? They're not. We have massive RSI divergence, and I talked about the long-term trend line. Right now, on the weekly VIX, we're at 2798. Simply, if we close above, next Friday, if we close above the 30 RSI, then I would consider taking the trade. And if we close above 30 RSI, we might also have a V2. Look, bar 1, bar 2 goes below bar 1, bar 3, if it closes above bar 1's close, would give me an under 30, over 30, and a V2 against the long-term trend line. All right, so there's a lot here. And speaking of that, let's take a look at the indexes in general of why VIX makes so much sense to me here with the right signal. Okay, let's look at the Qs. Qs, right now, we have a top, tall MACD bars. Here we're higher, lower MACD bars. Okay, this is bearish to me. So it would make sense that if this looks bearish to me, that VIX would look bullish to me. Let's take a look at the dollar. The dollar, again, is at the moment is inversely correlated with the market. Or in other words, if the dollar goes down, this is UUP, the market is probably going to go up. Well, look, here, bearish abandoned baby. Was it correct? Here it went up a little bit, but it certainly was correct. I mean, look, long term it was correct. Here, bearish. Was it correct? Absolutely. Here, island reversal, bearish. Was it correct? Yes. Here, bullish island reversal. Was it a tradable rally? It certainly was. And then again, just recently on Friday, we have a bullish island reversal. If this signal is correct and the dollar goes up, then most likely the market is going to go down. Let's look at another one, TLT. TLT are bonds. All right, there's been some great signals with abandoned babies on bonds. Look here, bearish abandoned baby. Was it correct? I would say so. Bullish island reversal. Was it correct? I would say so. What did we have on Friday? We had a bearish island reversal. If bonds go down, or in other words, if interest rates go up, most likely the market's going to go down. So you have two massive drivers here with major signals that happened yesterday. This is a bearish signal for bonds. This is a bullish signal for dollar. And these are both correlated with the market. So you can kind of see why my bias Doesn't mean I'm just going to go and short everything, right? I still need a legitimate signal. I'm long a lot of stuff, but what the driver markets, bonds, interest rates, the dollar, what these are telling me is to be very, very careful with chasing this market. So anyway, hope that was helpful. As an alternative to the one-on-one course that I do teach, I have a great online video course at udemy.com. I have the link in the description. It's very affordable. I teach you step-by-step how to trade the deep dip buy stock trading approach. I've sold so many of these courses all around the world. I've gotten so many good reviews and feedback on these courses. If you're not in the financial position to take the one-on-one course, then consider just buying the Udemy course and learning step-by-step how to trade the deep dip buy stock trading strategy. And if you like today's podcast, I really would appreciate it if you would just take 1 second. If you found something valuable here today, I would really appreciate it if you could hit the thumbs up button. It really helps to build the channel, lets the algorithm from YouTube know that there's some valuable content here so that you can get it out to more people. And I think it's good content. I mean, I definitely think it's been helpful. You've seen these trades I've had. They've really, really been good trades. So, if you found it helpful, please hit the thumbs up button, share it with your friends. And then, of course, as always, if you could please try to go out and do one nice thing for another human being today, it really would make the world a better place if we all did one nice thing for another human being. If you could go out, do something nice for an animal today, I would really appreciate that. They appreciate acts of kindness just like we do. And so one nice thing for an animal, one nice thing for a human, hit the thumbs up button, and that's all I ask for. Right? That's all I ask for. So I appreciate you being here, everyone. I really do wish you the best for 2024. I wish you health, happiness, prosperity, and good things in your trading and your life in general. If you have any comments or questions, please put them in the comment section. I'll do my best to get to them. But thank you so much for supporting me this year and for being here. And I hope we'll be together next year as well. But have a really good New Year's. Be good, be safe, and all the best in 2024. And God willing, I will be here next week, and we will see what's going on with what the market did this coming week. All right. Thanks so much, everyone. And on the way out here, I have to run the U.S. legal disclaimer. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.